So before we get too ahead of ourselves, let's talk about these levels and which ones I use and so forth. So there's a couple things to keep in mind when it comes to Fibos. There's plenty of different retracement levels. The ones that I've chosen, I feel, are the ones that the market tends to react to, hence a decision level. Okay, a reaction is a decision level. We want the market to react at that level. What are our reaction options? Stalling, reversing, or accelerating, right? So starting from the lowest to the largest, the 23.6%. Now notice how I've typed this in here. And basically all you need to do is click add, and then you're going to fill in these two sections. So the level itself is the calculation. That first column, the level column, you're going to draw the calculation itself. So 0.236 is a 23.6% retracement of the last move, low to high, or high to low, whatever it may be. So this number here is 23.6, you see down here. This represents a 23.6 correction, 23.6% of the move from this high to this low. Okay, this is 23.6% of this sell-off. All right, so making our way down the list, we have a 382, so 0.382, 50%, 0.5, the 618%, 0.6818, and by the way, this video, as well as other videos that we've recorded and are available at the Interbank FX YouTube channel. I believe we have some Fibonacci video there. You'll be able to refer to all this, so hopefully you're taking notes, but if you need a refresher later on, at some point later this month, we will post June and July webinars and possibly the first or second webinar for this month. Okay, so after the 0.618, we have the 786, 0.786, and 0.886. Now, these levels, and you can see them along the right side here as well, anything basically from 0 to 100 is a retracement. Those are retracements. We're retracing the move. If 100% represents basically the market coming full circle, okay, these are all retracements. Anything beyond 100% is an extension. So again, anything within the 100%, 0 to 100%, we're retracing that last move, whether it be a sell-off or a rally. Beyond the 100%, in this case above 100, these are extensions. So this would be 100% plus another 27.2. This would be 100% plus another 61.8% of this move. Okay, again, those are extensions. So the extensions that I use are the 1.272, which is 127.2%. I also like the 1.618, which is the 161.8%, and the 1.886, which is the 188.6%. Now, you'll notice in the description column, this is actually what you see on your chart. This is the actual visual part of the calculation. So the level itself is the calculation. The description is what you're going to see labeled here. Now, if you notice, I do 1.272, and then I have a series of symbols after that. Those symbols are the @ sign, the percentage sign, and then the dollar sign. Okay? And that is actually the formula, if you will, to have the price listed here next to the Fibonacci percentage. Because if you don't do this, this is not a default. If you don't do this, all you'll see is the 127.2, but it won't tell you what price it's at. To me, I like knowing the price. So you add the @ sign, the percentage sign, and the dollar sign. Okay. Another thing to mention is rallies and sell-offs will appear differently on different time frames. So you have to draw your Fibonacci's specific to the time frame. Now sometimes two very similar time frames like a 1530 or maybe a 3060, sometimes they'll share the same high and low of the last major move, whether that be a sell-off or a rally. Sometimes they'll share the high price and the low price. They'll be similar, in which case you might draw pretty much the exact same Fibonacci retracement level, but oftentimes there may not be. So don't assume there's only one Fibonacci. You might have not only one or two Fibonacci's per time frame, you might have a Fibonacci retracement per each time frame. So again, it is subjective and it's a little work intensive, but once you've got a high and low in place and price they're trading within that high and low, you don't have to do anything else in the meanwhile, except for look for what might be another series of highs and lows that you may want to draw a Fibonacci from. The more you do this, the more you actually draw Fibonacci's, the better you will get at it. This is not something that you will be good at right away. Okay? My best advice to you is just go ahead and start drawing different lines and levels. Look for a high point, look for a low point, look for those points that represent the top and bottom of a sell-off or a rally, and draw the Fibonacci. Okay? Just keep doing that. And what you'll see is when you've got the right one, oftentimes the current price action will kind of confirm it. We'll give you a visual confirmation, but we'll be able to see examples of that hopefully as we move along here. Okay, so let's tackle a few questions here that have popped up on the question window I see here in front of me. So first question regarding the different markets that you're in. Now, if you've been, and I appreciate, number one, I appreciate you, y'all sharing the markets that you're in with me. So I'm going to give you another tip, okay? And I certainly don't want anybody to shy away from participating because I appreciate y'all typing in your questions. But what I want to also share with you is if you're in a market, you're not just in, for example, the dollar Swissy or the cable or the euro yen. You're not just in it. You're in it from a particular time frame. Anytime we're in our room here and we're talking about a market, we're always going to get the habit of talking about the particular time frame on which we've set up, well, analyzed, set up, and entered the trade. Because I might be in the dollar Canada, but I'm not just in the dollar Canada. That's vague and general. What time frame are we in? Because we might be looking at a different set of highs and lows for rallies and sell-offs. We might be looking at a completely different market cycle. So let's think specifically. When we're communicating here in the chat room, I would love for you to tell me the markets you're in. I appreciate it. But also tell me what time frame it was that you analyzed to come up with the trade or the setup that you're looking at. And if you're in a trade right now, let me know you're in the trade, when you ask your question. And tell me again what time frame you're looking at, because that's when we really start to get specific about the way we're looking at the market. Remember, each time frame is a slice of psychology, long or short. Okay? The daily time frame, for example, of the dollar Canada is in a markdown cycle. It's heading lower, while the 15-30 minute are arguably heading up higher. The 60-minute, and let me show you here. Let me go and show you here. So let me make my point. So the daily chart here, heading down. The wave, you can see the angles of the wave, the angle of the three lines of the wave heading down. 240-minute. I know it's kind of tough because I have all these notes here, but you can see the three lines of the wave heading down. How about the 1 hour? The 1 hour is actually heading neutral. It's actually moving in a more neutral sideways market, while the 30-minute is heading slightly higher. The 15-minute is in a better markup cycle, and then, for example, the 5-minute is in a kind of wishy-washy, maybe distribution market cycle with what could be a double top here. So same pair, 1, 2, 3, 4, 5, 6 different time frames. and different psychologies are represented on almost each of them, or these variances of the different psychologies. Okay? So that's number one.